Amazon paid $0 federal income tax in 2018. Amazon's founder is the third wealthiest person in America, but the company paid no corporate income tax in 2019. While this might sound unfair, this is all done legally. How is that possible? For starters, Jeff Bezos is wealthy because of the value of Amazon stock, but Wall Street adored the company for years, despite the fact that it was a curiously unprofitable retail and technology behemoth. However, Amazon has recently emerged as a consistently profitable company, reporting nearly $137.4 billion in earnings last year. Despite this surge in profitability, the company's earnings more than doubled between 2017 and 2018. Amazon's tax bill has actually decreased. According to an Institute on Taxation and Economic Policy Analysis, the company paid no corporate income tax in 2019, an astonishing figure that prompted dozens of news stories. The tax treatment of stock-based compensation, which Amazon offers to the majority of its employees, is an important part of the story here, with the slightly unusual feature that the more successful your company becomes, the lower your tax bill becomes. In other words, Amazon did not avoid paying corporate income tax in 2018 despite a massive increase in profits, but rather because of it. If this appears to be a policy failure, the real issue is probably not Amazon's light tax bill, but the extent to which a policy initiative launched in the early 1990s to limit CEO pay has completely backfired. It's worth noting that Amazon isn't lowering its tax bill through traditional technology company tricks, like stashing profits in offshore subsidiaries or declaring itself a foreign company. Amazon's sales are primarily in the United States, with Germany ranking second. Germany is also a relatively high tax jurisdiction. Amazon isn't cheating anyone here. It just legitimately owes no taxes. Some of this is due to Amazon's ability to take advantage of the Research and Development Tax Credit, a non-controversial policy that encourages profitable companies to invest profits in research and development. Congress routinely extends this on a bipartisan basis, with the belief that research into innovation is beneficial, and Amazon is clearly a company that does a fair amount of research and development. The second reason is that the Trump tax bill included a temporary provision that allowed businesses to deduct 100% of their investment in equipment. This is a contentious idea, but it has some bipartisan support. Obama White House economist Jason Furman likes it, for example. More broadly, when Democrats complain that corporations are diverting too much of their profits into share buybacks rather than investing, they are effectively saying that they wish more corporations behaved like Amazon, which does not engage in share buybacks and invests heavily, and this provision of the Trump tax bill encourages corporations to do so. The last and most important change in 2018 is that companies can deduct the cost of stock-based compensation from their taxable earnings, even though it does not cost companies anything to give employees shares of their own stock. Furthermore, the way this cost is calculated is that the higher your share price rises, the greater the deduction for distributing shares. So precisely because Amazon's profits increased, the price of the company's shares increased significantly, as did the value of these deductions. That may seem counterintuitive. In general, more successful businesses should pay higher taxes, not lower, but there's a good accounting reason for it. At the same time, the entire trend of companies offering stock-based compensation packages is essentially a massive loophole in a decades-old tax provision designed to discourage lavish executive compensation. Bill Clinton and congressional Democrats devised a solution to Reagan-era America's growing pay inequality in 1993, the Section 162M of the US Tax Code. While businesses typically pay sales taxes to state and local governments, the federal government taxes their profits. Revenue paid to employees as salaries and benefits is not profit and thus is not taxed. However, Section 162M made an exception to this rule, stating that any salary of more than $1 million paid to top executives would not be deductible for tax purposes. The goal was to deter lavish executive pay packages, except that there was an exception to the exception. Compensation in the form of stock options or stock grants was still deductible. In practice, the 1993 change encouraged companies to use a lot of stock-based compensation for their executives. But here's the important part. While a company could provide stock-based compensation by taking money from the bank, using it to buy shares on the open market, one of the dreaded share buybacks, and then giving those shares to executives, that is not how it works in practice. Amazon or any other company can simply issue more Amazon stock whenever it wants. This costs Amazon shareholders because creating new shares tends to devalue existing ones, but it has no direct financial cost to the company. Here's what's even weirder. When a company's share price goes up a lot, the value of stock-based compensation rises as well. That's by design. Part of the goal of stock-based compensation is to ensure that executives are compensated for their performance, or, at the very least, that rank-and-file employees share in the company's success. But this means that, in accounting terms, when a company's share price goes up a lot, as it might if, say, it successfully doubled profits, the value of the tax deduction for the stock-based compensation also goes up a lot. That's exactly what happened with Amazon. Thanks to a good year for the company, its Securities and Exchange Commission Form 10-K shows it recorded about $1 billion in deductions for stock-based compensation, eliminating what would otherwise have been a non-zero tax liability. Long story short, it's all legal.